Hello, Happy New Year and welcome to your New Look Investor Update for January 2023. I'm Brad Holland, Director of Investment Strategy at Nutmeg. I'm here to answer questions about 2022, December, the month just passed, and our outlook for the year ahead. 2022 was a difficult year for both bond and equity investors, with most major equity markets ending the year in negative territory and bonds delivering some of their worst performance in over 20 years. This joint fall, referred to in the industry as positive correlation, was really all about the inflation shock that occurred and how central banks were forced into dramatic adjustments. These two things, the inflation shock and the dramatic central bank response, were a challenge for bond markets, causing bond prices to collapse. The extent of the losses experienced in bonds is usually the preserve of much riskier assets. The speed and size of this bond collapse and the impact of inflation on consumer demand also caused most stock markets to fall in 2022. The US was down just under 20% for the year. European markets were down 12%. Japan was down 4%. But the UK large company index, the FTSE 100, actually bucked the trend and rose 4% in the year. Well, it was UK large caps that did so well. Smaller and medium-sized companies suffered the same poor performance of most other markets. There are several key reasons. First, the pound depreciated by over 10%. So large companies with foreign profits had these translated into sterling at the better foreign currency exchange rate. The same factor also helped Japan's large companies to limit their loss in 2022. But there were two differences between Japan's overall small loss and the UK's overall gain. And the first is the UK's higher dividend payments, and the second is, well, the impact of energy prices. Around 14% of the UK equity index is made up of oil and gas companies, while the Japanese are energy consumers, not producers. Also, the UK benefited from some healthcare and material company performances. On the UK, expect a lot of negative press around politics and GDP forecasts. The ultimate impact from all the industrial strike action is difficult to know, but should be mitigated by the ability of many to work from home. On the extent of a UK recession, the truth is that the worst industry forecast for 2023 production will still make it the shallowest recession in several decades. And we observe an ongoing negative media bias that doesn't really reflect this. However, households in the UK and around the world will still find it tough this year due to high energy and rising mortgage costs as policymakers are forced to reverse out of easy policy, the very low interest rate that became the norm of the last decade. One of our key themes for 2023 is our belief that inflation will moderate globally. Supply chain issues are continuing to ease, especially in China, where COVID lockdown restrictions have been loosened. And on the demand side, higher interest rates across the world should lower demand-led inflation. Higher interest rates also mean government bonds are now offering the highest yields we've seen in decades, which means they will contribute more meaningfully to portfolio income, despite depressed prices. That's a second theme. Third is that we think the dollar will weaken in 2023 as global financial conditions stabilise. This could be good news for emerging markets that tend to borrow in dollars, lowering debt servicing costs. This, alongside weaker valuations of emerging market equities, which performed poorly in 2022, could create opportunities for investors. Now, you can read more about our 8 investment themes for 2023 in a blog posted recently on the Nutmegonomics section of our website and app. Yes, given the weak economic environment that we've moved into and the ongoing impact of elevated inflation, we've reduced our equity holdings slightly across the portfolios. It's a more defensive, not pessimistic view on equities. It recognises a more tepid economic environment where policymakers are encouraging slower growth. We have, in fact, increased or maintained our exposure to cheaper equity markets, the UK and emerging markets, while limiting our exposure to more expensive ones, notably the US. With some of the proceeds, we've invested into more high-yielding fixed income assets like investment grade and high-yield corporate bonds. Again, we explained all these changes in more detail in a blog about our positioning going into 2023, which you'll find on the Nutmegonomics website. As usual, throughout 2023, the investment team will keep you updated via regular blogs, the monthly investor update, as well as the mid-month view from the investment desk videos. If you have any questions or suggestions for a topic you'd like us to discuss in next month's investor update, you can contact us via social media, email, or in the comments section below this video. Thanks for watching.